Hi everyone, this is Jason Burek of Wall Street for Main Street. Today is Friday, June 18th, 2010, and this is your weekly commodities market wrap-up for the week of, like I said, Friday, June 18th, 2010. On a day that the NASDAQ, Dow Jones, Industrials, and the S&P 500 were all up, gold was also up. Gold closed above $1,250 an ounce, which was considered a key resistance level. What this means is that gold should now test higher resistance levels. Most people on their technical analysis with Fibonacci are estimating that gold will test at least 1,300. I have seen a hedge fund manager and former hedge fund trader from the Online Trading Academy diagram that gold could test $1,330 as a price target within the next couple months. I saw that a couple weeks ago. And I also think that silver is on its way to confirming gold's breakout. Silver closed above $19 an ounce for the first time in a little while. Silver is doing a nice good job. That is the first hurdle. As many of you have already heard me say, there is a couple more hurdles after hurdle number one. Hurdle number two for silver would be the $20 an ounce target, and then 21. If silver gets above $21 an ounce, all bets are off. That would be the confirmation of a full precious metals breakout, technically at least. Fundamentally, the fundamentals have not changed. Everyone who pays attention to the Wall Street for Main Street Facebook fan page and to some of my other blogs and other content and to Mo Dawood's content know what we think of gold and silver fundamentally. So don't really have to explain that much there. As far as the base metals go, copper and some of the other guys, definitely overhead resistance. Copper is having a lot of trouble staying above $3. What this says to me is people are unsure whether or not emerging markets are really recovering or not, whether or not there's really global recovery. The inflation bet is also not in right now, except for gold and silver, and gold and silver also have other political turmoil components. So copper will probably lag like silver since it's an industrial component, and then it will probably catch up depending upon that. But the better bets as of right now obviously are gold and silver in terms of technical trading. Oil is over $77 a barrel. In terms of support and resistance levels, some key resistance levels for oil to overcome next would be around $80 a barrel, and then $82, and then $85. If oil can get through those resistance levels, oil will go above 90 and should challenge the 92 to 96 range. There's also resistance at those two numbers. So it will be interesting to see. There's definitely some rumors of some more conflict in the Middle East. Obviously, that could happen at any time. So if you're short oil, be very careful. If you're a trader, you probably know your risk, hedge. Oil definitely looks like an interesting an options bet right now. It's perhaps a long straddle around 80. There might be some money to be made at like 80 or 82 as a long straddle where you buy a put and buy a call with some long outdated stuff just in case oil goes through the roof or in case it drops. Because I've heard definitely, what's funny is in the last couple weeks, I've heard energy experts say it could go either way. So I definitely think oil's in a trading range for a short term at least, and we'll see what happens after that. But long term, it's just too early to tell right now based on a lot of factors. Everything's still fluid on what can happen. I wanted to spend a lot of time talking about natural gas with you guys. I think the natural gas market is going through a market reevaluation. Many of you commodity traders and people who follow have asked about natural gas in the past, and I was not bullish on it, and neither was Mo technically from a technical standpoint. Mo did a technical analysis chart of natural gas, and it showed it was consolidating, but what has happened in the last few months is, based on my reading and my research, and especially in the last couple weeks in the articles that I've read, is that natural gas has undergone a market reevaluation. There is some technical jargon involved between wet gas and dry gas, and the profit margins, the spreads on wet gas are a lot better than the profit margins on dry gas. Dry gas would just be methane. I can link you guys to an article that explains this more in depth for you guys who want to know. But for I would definitely take a look at the natural gas producers oil and natural gas producers, but those guys who have the wet gas instead of the dry gas. And that will explain things more in the margin component. So the natural gas market, guys, has been reevaluated within, like I said, the last couple months, and that's why natural gas is around 5. Even though this is the summer, and normally this is a low point for natural gas. So it looks like because of that the wet gas, natural gas producers are going to be profitable. So that's a good thing. It looked to me over the last year or so that these natural gas producers in general were wasting a lot of capital, continue drilling and bringing more supply on market when there wasn't really storage facilities for these natural gas here in the United States, and they were just over drilling. And it looked like a lot of these guys were going to go out of business. I know with the XTO ExxonMobil merger that XTO went to ExxonMobil because they were even worried about their financial strength. So when you have a giant in the natural gas plays, these unconventional shale and other plays like XTO Energy, and they were worried about it, you know it was very serious. And Chesapeake Energy had a lot of problems. You had Audrey McClendon, their CEO, who took out margin and bet on his stock at the very top, and then the stock crashed. And you have some other examples of that. So these unconventional plays with the wet gas, there are specific areas of the United States where the wet gas plays are going to be more likely. You're going to have to do your own due diligence on that. But I can get you the articles you need on your on the technical jargon to explain that if you guys are interested. I just took a look at some of the soft commodities. They're not really doing much. They're still lagging greatly. Coffee was up. There was a nice little article, I believe, in the Daily Reckoning within the last week or two about how people should be buying coffee's futures. So that was a nice little pop there. The Daily Reckoning guys are really good contrarian investors. Bill Bonner and his crew over there do a fantastic job. They're libertarians and they're Austrian economists. And they definitely think outside the box, and they look for interesting ways to help you get profits. And they're good value investors too. They're not really technical guys for the most part. Maybe a little bit of technical stuff, but not too much. They mainly focus on value, like I said. So everyone have a great weekend. I gave you some resistance and support levels to look at for gold and silver. I'd say there's a very good percentage that gold is going to be making a run at 1,300 in the next few months, and probably higher than that. So I'd say probably by the October-November area, gold should be around 1,300, and maybe by the end of the year, gold might even be around 1,500. I'd say the odds are increasing about that. But I will be listening to Ted Butler on King World News tomorrow on his weekly metals market wrap-up, and see what he has to say about that too. So everyone have a good weekend, and hope you had a nice trading week if that. And if you're a long-term investor, you might want to take a look at natural gas. And it looks like your time could be, and also oil, and it looks like your time could be running out on gold and silver maybe, depending upon whether or not they can get over those hurdles. So everyone have a great weekend.